just did something that should not happen in a normal market. It plunged hard, shook people out, and snapped right back like it never fell, a double-digit drop in a couple of days. Then you're staring at the highs again. So, what exactly happened? And why are some people suddenly talking about price levels that sound absurd? This isn't the slow, polite kind of bull market where price climbs, rests for months, and gives you time to think about it. This is the kind of advance where corrections are measured in days. Blink and you don't miss a candle. You miss the move. So in this video, I'm going to break down the real story behind silver's behavior. Why the whiplash sell-offs keep failing, what a major trigger just signaled, and why the next phase could be the one that makes latecomers furious and early buyers grateful. And near the end, I'll share the one relationship that has historically flipped silver from strong to violent. And when it breaks, things get weird fast. I'm John A., and if you're here for straight talk and clear signals, you're in the right place. Now, just before we dive in, quick note. If you want silver-related success stories from real people, how they played cycles, stacked patiently, and turned discipline into serious outcomes, there's a link in the description to a separate channel that focuses on that. Go subscribe over there too, because those stories can why this is not a normal bull market, keep you grounded when the chart tries to mess with your head. All right, jumping in. And yes, I'll show you the exact moment this changed, because once you see it, you can't unsee it. Stick with me to the end. Today, markets don't move from one extreme to fair value in a straight line. They tend to overreact. When a market spends years trapped, compressed, and ignored, it doesn't calmly walk into a new reality. It often launches through it, overshoots, and forces everyone to rewrite what they thought was possible. And silver has been trapped for a long time, not because silver is weak, but because silver is complicated. It's not just a metal. It's not just an industrial input. It's also a form of money, an asset that behaves differently the moment confidence in paper promises starts wobbling. That means silver can ride two waves at the same time. And when those waves synchronize, you don't get a normal rally. You get a squeeze, a scramble, and a stampede. This is where the crowd keeps getting it wrong. You'll hear the same chorus every time silver rips. Sell it. Take profit. It has to go back to the old level. It has to retest the breakout. In calm markets, that kind of thinking can work. But look at what just happened. The market dumped fast, punished the weak hands, and recovered so quickly that anyone waiting for a slow, comfortable entry got left behind. That kind of action is not a fluke. It's a message. It says the underlying bid is stronger than the panic sellers and stronger than the people trying to cap price. So the question is, why is the bid so strong? Let's break it into two engines that can push silver higher. Engine number one is monetary. When people start treating silver as money again, when they stop thinking of it as a commodity trade and start thinking of it as an exit door from currency risk, demand stops being price sensitive. People don't buy because it's cheap. They buy because they don't trust the alternative. And here's what makes this cycle dangerous for doubters. Monetary demand tends to show up suddenly. It waits, it watches, and then one trigger hits. Maybe a policy shift. Maybe the trend shift. Most investors are missing liquidity event. Maybe a confidence crack, and the bid appears like someone flipped a switch. When that happens, the market doesn't give you time to argue with it. Engine number two is industrial. Silver is in the wiring of the modern world. Tech, electrification, solar, data, infrastructure, whatever buzzword you prefer, silver is in the guts of it. And the story investors keep underestimating is that industrial demand doesn't politely pause just because price is rising. It has deadlines and contracts. If supply is tight, buyers pay up. You don't need perfect data to see the trend. You can see the strain in the way price behaves. Fast drops that don't stick, dips that get eaten, pullbacks that feel like traps. That's the fingerprint of shortage pressure colliding with rising attention. And that brings us to the part almost nobody watches closely enough, silver's relationship to gold. Most people stare at the silver chart alone and assume history will repeat in the same rhythm. But the explosive phases in silver have often been preceded by a very specific event. Silver starts outperforming gold in a clean, undeniable way, not for a day on day. A closing basis that forces the market to admit this is real. Here's why that matters. Gold is the parent metal in the minds of big institutions. It's the one treated like a reserve asset. Silver, by comparison, is the wild cousin, cheaper, thinner, more volatile, and easier to squeeze. So when silver begins to climb relative to gold, it can signal the market is shifting from conservative protection to aggressive positioning. And that's when silver can go from climbing to flying. Think of it like this. Gold is the heavyweight. Silver is the lightweight with a knife. When silver starts winning the race, the crowd realizes the old playbook is breaking. And once the playbook breaks, targets get revised upward in a hurry. A veteran momentum analyst recently made a point I think is critical, even if you disagree with his exact numbers. The mistake technical analysts keep making is assuming silver will behave the way it behaved in the last couple years. They zoom in, measure normal overbought and oversold ranges, and build neat little targets like the market is obligated to respect their ruler. But when a market escapes a multi-year cage, normal stops mattering. In those periods, it's common to see acceleration in a compressed burst. Months of movement in weeks, weeks of movement in why sharp sell-offs are failing, and what that signals days. And if you look across history, there are examples where a long range finally breaks and the market doesn't drift higher. It violently reprices. This is what people mean when they say it's entering a new reality. And when a new reality begins, the most dangerous thing you can do is anchor to the old one. That's why the "it must go back to the previous ceiling" crowd keeps getting steamrolled. They're treating an old boundary like it's permanent law. It's not. It was a psychological line created by years of boredom, bad positioning, and disbelief. Once a market breaks through that kind of ceiling and holds it, the ceiling doesn't remain a ceiling. It becomes a floor until the market finds the next place people stop believing. Now let's talk targets, because this is where people either get excited or roll their eyes. One widely discussed outlook suggests a minimum long-term target in the low hundreds, with a scenario where silver could reach several hundred if financial stress intensifies. Is that guaranteed? No. Is it impossible? Also, no. The way to think about it isn't, will it hit 200 or 500? The way to think about it is, what kind of market structure would allow that to happen? Because if the structure is forming, you don't want to be emotionally unprepared when price starts doing things that make the comment section melt down. Here are the ingredients of that structure. First, volatility compresses, then expands. You get a long period where price feels stuck, enthusiasm dies, and only stubborn holders remain. Then, once the breakout comes, it doesn't feel friendly. It feels unfair, and that emotional reaction is part of the fuel. Second, tight supply matters more in thin markets. Silver isn't a deep ocean like a major equity index. It's more like a lake. When large buyers arrive, the water moves. When shorts get nervous, it splashes. Third, the money narrative returns. If enough participants start treating silver as insurance against currency dilution, policy instability, or systemic stress, then sellers dry up. People stop thinking, "I'll sell when it feels rich," and start thinking, "I'm not letting this go unless I'm forced." That shift alone can change the character of an entire market. And here's the cliffhanger. When those three ingredients combine, the chart stops being a chart and starts being a headline generator. That's when silver stops being talked about in niche corners and starts showing up everywhere. But we're not fully there yet. What we're seeing now is the setup, the warning shots, the market testing the edges of disbelief and finding out how quickly it can recover. Did you notice how fast sentiment flipped during that sharp drop? One brutal move, and the silver versus gold trigger that can unlock acceleration, suddenly the loudest voices were calling for a full collapse. And then as soon as price bounced, those voices went quiet. That's not analysis. That's emotional whiplash. And markets love punishing emotional whiplash. Now look at the pattern that keeps repeating. Swift sell-off, immediate recovery, new push. That pattern tells you the market is rejecting lower prices. It's telling you there are buyers waiting under the surface. Not buyers looking for a deal, but buyers who see dips as a chance to secure supply. And when you're in that kind of environment, the multi-month correction mindset becomes obsolete. The market doesn't gift you long rest periods because demand doesn't take long naps. It's industrial, it's monetary, it's structural. So what could the next trigger be? It could be a clean monthly close that confirms silver is outperforming gold in a way that breaks a decade-long barrier. It could be a policy shock that forces investors to reconsider real assets. It could be a credit event that makes the safe assets look less safe, or it could be as simple as momentum, price moving high enough that the sidelines get tired of waiting and chase. And when chasing starts, silver doesn't jog, it sprints. We've seen versions of this story in other markets too. A commodity trades in an old range for years. Everyone assumes that range is permanent, and then one breakout changes the entire conversation. Suddenly, price doesn't just rise, it reprices, and the reprick happens in a compressed window that makes it feel like you skip chapters. That's why the boring years matter. They are the spring being compressed. So if you're thinking, okay, but what do I do with this? Let's keep it practical. If you're already positioned, the main danger isn't price. It's your own behavior. It's panic selling a dip that recovers, then buying higher because you can't stand being wrong. That cycle is how people donate their gains to the market. If you're not positioned, the danger is waiting for a perfect entry that never arrives. Because in fast cycles, the market doesn't reward perfection. It rewards preparation. And if you're somewhere in the middle, holding some, watching more, then your edge comes from understanding what phase you're in. Are you in a normal grind, or are you in the early part of a regime change? I think we're in a regime change, and I'll tell you why. The debate has shifted from will silver ever break out to how far can it run? That shift doesn't happen in a sleepy range. It happens when the market has already started moving into its next identity. Now, I want to address the elephant in the room, the idea that this move is manipulated, suppressed, or capped. What a new price reality really means, people argue about this endlessly. Here's my take. Whether you believe in suppression or not, the only thing that matters is what price is doing right now. And right now, the market is behaving like it's absorbing pressure and pushing higher anyway. If sellers had real control, those sharp dumps would stick. They would cascade, they would break the structure and keep it broken. But that's not what we're seeing. We're seeing dumps that feel violent and recoveries that feel insulting. That is not weakness. That is resilience. And resilience is what precedes expansion. Now, earlier, the one relationship that can flip silver from strong to explosive. Let's spell it out. When silver climbs versus gold and holds that outperformance, it's a signal that the market is leaving the old hierarchy. It's saying the crowd is willing to move further out on the risk curve inside the precious metal space. And historically, that is when silver can accelerate so aggressively that traditional targets stop making sense. That's why some analysts are throwing out numbers that sound crazy, not because they're fortune tellers, but because in a repricing event, the range of outcomes widens dramatically. The conservative person hears hundreds and laughs. The prepared person hears it and asks, what would need to happen for that to be plausible? That second question is how you stay rational in irrational markets. So here are two questions I want you to answer in the comments. First, do you think silver's next big move will be driven more by monetary fear or industrial necessity? Second, if silver rips higher fast, what will you do differently this time? Hold through the volatility or try to trade? Every swing? Now, as we get close to wrapping up, let's talk psychology because this is where virality happens. The next phase is when price moves so fast that people start taking screenshots. It's when mainstream attention shows up late, interviews pop up everywhere, and the market becomes a daily talking point. And when that happens, the final fuel is not logic, it's emotion, it's regret, it's fear of missing out. It's the pain of being left behind, and silver is one of the best markets in the world at turning those emotions into bad decisions. That's why you need a framework before the move, not during it, because during it, the chart will bully you. You'll see a huge green candle and feel like a genius. And then a sudden red candle will make you feel like an idiot. And if you let your identity get tied to the next candle, you'll get shaken out of the trend you said you wanted to be in. So here's the mindset I think matters most. Expect abnormal behavior. Expect fast pullbacks. Expect headline-driven whipsaws, and most importantly, expect the market to punish the crowd, because key levels and scenarios to watch next if this really is a transition into a new reality than the crowd's old habits, waiting for months of correction, assuming the old range is permanent, believing every scary dip is the top. Those habits become the exit liquidity. I'm not telling you to be reckless. I'm saying understand what kind of market you're watching. This is not a sleepy, well-mannered advance. This is a market with two engines, tightening supply dynamics, and a history of violent repricing once certain triggers break. And if that trigger is already in motion, the next stretch could be the kind people remember for years. So here's the short CTA. Hit subscribe now so you don't miss the next update. And one last reminder, check the link in the description to that Success Stories channel and subscribe there too. Sometimes the best way to survive a wild market is to hear how others kept their discipline when things got crazy. Because if silver really is about to explode, the people who win won't be the loudest. They'll be the ones who were ready before the crowd showed.